Good morning, ladies and gentlemen. Very happy to have you here. My name is Asim. I'll be your instructor for the day. And again, welcome to this session along a series of sessions provided throughout the hackathon's activities. I would like to take this chance to thank the TRA team and thank the TRA Virtual Academy for availing this chance and making this session possible. Also, I'd like to take a couple of seconds to introduce myself. My name is Asim. First and foremost, I define myself as an entrepreneur. Throughout the past couple of years, I've been running a Cairo-based marketplace that facilitates and organizes the trade of certain amounts of or certain types of waste that goes back into the value chain. In addition to or afterwards, I started working in a VC firm in Egypt called Innovators, which focuses on seed and early stage investments. Also, for a while, I worked a bit on deploying seed and early stage impact investments in sub-Saharan Africa through a Europe-based venture capital firm. Today, we're going to talk about a very interesting topic. And as I'm sure that throughout the past couple of sessions, you've been engaged and you interacted with some of the main key concepts that drives and maintains a business, such as the business model canvas, the value proposition, or the resource and operation plan. And today we're going to dive a little bit deeper into managing startup finances. It's quite an interesting topic. Some people find it a bit dense, but I hope that throughout the session for today, we're able to uncover some of the mystery and some of the hardships that usually people face when thinking about startup finances. So let me start right away. If you give me a couple of seconds. All right. So today, my objective out of the session is to discuss three main key elements. First of them is to give you a little bit of introduction and fundamentals about the most important accounting principles and how to read financial statements, how to understand financial statements. Also, we're going to talk a little bit about their structure and the included items as well. In addition, we're going to start talking about financial planning. How can we start to derive and analyze and then forecast a financial plan that estimates and reflects the future growth and the future trajectory we expect for our business, and how we could translate that into meaningful projections that we could share with many stakeholders, whether you're going to share them with investors or simply share them with the team to discuss in order to know, understand, and expect what you need to do in the short term, especially in terms of liquidity and cash flow and so on. Third main item, which is very interesting, is how do investors think about and go on about evaluating startup ideas. So how they dissect a startup idea when they see one, what do they think about? And the rationale here is really to try and put you into the investor's perspective and frame, which will help you understand how do investors think about evaluating startups, which also increases the probability of securing an investment or accelerating your growth in terms of access to capital. So let's start. First of all, before diving into the topic, I want to clarify some important points, which are the definitions. There is a clear difference between accounting and finance. And the really easy thing is to think about it this way. Accounting is the process of recording and organizing all the company's transactions into a consolidated or a centralized place or location. Whether it's reports, whether is it a log of invoices, all of that you take and then you build upon it the complete financial statements, which is simply a record of what's going on with your business. How is your business getting affected by the time? So that's the most important definition about accounting. On the other hand, finance kicks in after a complete and a sound process of recording all the transactions that happen in your company. So finance is the process of measuring how much funding do you need, measuring the performance of the company, measuring at some points, of course, measuring the value of the company itself, and then use that insight and information to try and devise a strategy or a plan that helps you to grow, that helps you secure capital or adjust your numbers or adjust your projections or your plan going forward based on the insight that you got out of analyzing and measuring the performance from the accounting infrastructure that you use to record all your transactions throughout the business. So the thing is about managing startup finances. Some people really see it as a very complicated topic. Most entrepreneurs think that, all right, to manage that, I need a huge team of accountants. I need very extensive background knowledge about some accounting terms, which is true to some extent. But what I'm trying to convince you with at the moment is that it's really, really simple to manage a startup finance in the beginning and as you grow. And the thing is, you have to understand there are a couple of things that you should know and others that you should understand or calculate. So what you should know are simply three things. You have to know the balance of your bank. So how much money do you have actually in the bank right now? You have to know how much money you're getting or you're expecting throughout a certain period of time. And of course, money out. You have to know how much you're spending on the team, on building the product, on marketing, on sales, etc. And these things are really simple to know. You could simply know them by looking at your bank statement. And the other things that you should understand and calculate are mainly four things. So you should understand the burn. How much are you spending per certain amount of time? You should understand the runway. How much time do you have with the current balance that you have in your account to keep operating? The growth rate. How much are you growing each month, each week, each year? And finally, is your business alive, or the other side of it, is it dead? So let's start in that order. Burn is simply money out minus money in. So let's use a quick example. If my expenses is 150,000 and the revenues coming into the company are 50,000, so the net change in bank balance is the difference of these two numbers, which is 100,000. And it's very, very simple. And you need to know it to understand the spending trends that you have over time. Also, if your business operates in a bit fragmented manner in terms of sales, so if you're closing sales cycle not each day or each week, but the sales cycle maybe takes longer than a month, so maybe you take an average across an elongated or extended period of time. So simply, again, burn is money out and money in minus money in, or the net change in your balance during or throughout a certain period of time. And then you could use the burn that you calculated to start figuring out your runway. Runway is simply the amount of time left with the current spending trends that allows you to keep operating on the same numbers or on the same growth. So simply, your runway is your bank balance divided by your burn. So assuming that in the business account or in the company's account, you have 350,000 in the account, and you're spending, your net burn is 100,000 each month. That means that you have around 3.5 months of operations. This number is really, really important. And one of the few problems, or one of the problems that some entrepreneurs make, is not looking at their burn and runway frequently enough, and not at some points or at some instances not really knowing what is their runway, which of course, as you can see, it's critical because you need to understand how much time do you have left until reaching a certain milestone or a certain progress point or a certain objective. So if you understand that you are going to the market in 6 months, but your runway tells you that you only have around 3 months of operations, then you need to go back to the drawing board and see, okay, what can I do to change that? Because you either have to accelerate the process, then you have to change your plan and then go to the market a little bit earlier so you can survive without needing to gain additional capital, or maybe you can cut down costs somehow in order to extend your runway. Or at some points, then you know that you need to go on and start fundraising right now in order to extend your runway. Great. The third thing that we need to know about managing a startup, an early stage startup finance, is growth. We need to understand how much are we growing. We need to understand the percentage, because as I will dive into a little bit later, it's very important, and it's a huge or a key and a critical metric that not only investors use, but also entrepreneurs and other stakeholders to try and define how much you're growing and how to quantify the potential of the startup growing very quickly. So again, calculating growth is very simple. It's simply the percentage difference of revenue between 2 time periods. So if I want to calculate the growth for the month of July, then I need to get that revenue and then subtract it by the revenue of the past month, and then divided by the revenue of the past month. So in that example, July revenue was 60K, and then June was 50. If I simply subtract those numbers and then divide by the original month or the earlier month, then I arrive at a 20% monthly growth rate. And also, you want to keep, as much as you can, a consistent growth rate, because as your numbers grow, then with a constant growth rate, you have an additional growth in terms of absolute number, which gives you scalability, which gives you increasing growth, which usually what investors look for when assessing the potential of startup growth. The final thing that we need to know is whether your business is alive or not, or the other side of it, is it dead or not? So the assumption here is very simple. Given a constant monthly expense and given an increasing monthly revenue, do you have enough cash to survive until the point of being profitable or not? And this is really very useful because it helps you visualize how much money do you need and it helps you sort of iterate and modify your numbers. So this is a very nice tool. It's an open source tool created by Paul Graham. It's called Startup Growth Calculator. And as you can see, you could edit 3 things. One of them is the monthly expense. One of them is the monthly revenue in green. And finally, the final thing is the growth rate. So if you can see here, you could play around with those numbers and see, according to your plan, how much money do I need until reaching the point of profitability, and whether do I have the appropriate plan or the suitable or the convenient plan on securing that capital or not. And because, as I said, if you find out that you don't, then you need to go back to the drawing board and make some changes, whether increase your growth somehow, whether decrease your expenses, or start fundraising for additional capital. And remember, the best entrepreneurs do more with less, which is the concept of bootstrapping. And a very important point to consider here is that you should use those numbers that originates from your accounting efforts and finance efforts as a way to assess where you are right now. So they're not a tool to, we shouldn't think about them in a manner, in a cosmetic manner somehow. We shouldn't try to make the numbers more attractive to other people, but they should be a really critical measuring tool of how we are performing. So think about them this way, and always, you have to, at all times, you have to know these numbers. Whether you're talking with the team or potential investors, you have to know how much time you have left in terms of runway, how much money you're spending in terms of burn, and how much money do you need until being profitable through offering your service or selling your product. Here I want to start talking a little bit about modeling for a second, because we'll get to that later. But as you build the model, as you start figuring out how to translate my views and my vision into numbers, I want to simply give a very key principle, a really key principle about it. So you have to start with assumptions. Don't start with the numbers, and then you could try and test and verify with the numbers later, and we'll get to that in a bit. But just keep in mind that when thinking about the model or thinking about finance in general, start with the key assumptions. And then as you go on and grow, you'll have the chance to iterate and to test and verify whether your numbers are correct or not, whether you're talking about a forecast of revenues or costs and so on. Great. At this point, I'll start talking a little bit about the financial statements. So the financial statements are very important tools that allow us to understand the position of our company from different vantage points or from different perspectives. The most important tool, or at least the most important one for the early stage startup, I would say, is the cash flow. And I will try to explain it more extensively than the others. And I'll start explaining the difference between each statement, the rationale or the logical breakdown and structure of each statement, and when do we use each statement, and what do each statement tell us or signifies. So starting with the cash flow is very important because it helps you make sure that you have enough money to survive, as I've been talking about before. Because cash is really the fuel that operates your business and lets it and makes it run and run and run. And without cash, you don't have the ability to pay your team. You don't have the ability to procure services. So you'll find yourself hauling to a stop. So, and you'd be surprised how many startups run out of cash with no proper planning. So cash flow statement is very, very important. It also helps plan your investment needs, as I said. And at its core, it's a very quick and easy way to measure growth. Deals you need and then pay later that would help you with having a healthy cash flow that allows you to move and operate within the business. So again, back to the cash inflows. So there are three types of cash inflows. You could either have cash inflow through the revenues, which is generated by the core business activity that is being conducted throughout your operations. You could get investments from people who are interested to help you and passionate about seeing you succeed and grow. They could be friends and family. They could be angel investment groups or angel investors, or they could be typical venture capital firms and private equity firms. The third type of cash inflow is you could get a grant, you could get a donation, a sponsorship, which is usually for free. But remember, what do you need to do? Because usually grant money involves having a certain agenda or a common goal that you have to work for it towards getting that grant or that certain sponsorship. In terms of cash outflows, the money coming out of your business can be classified into four main ways. First of all is the variable cost. So the variable cost is the direct cost that varies with how much are you selling. So if we imagine a typical manufacturing business that sells a certain product, so the variable cost would be the cost of raw materials, for example, and it's directly related and directly changes with how much you're selling. So that means the raw material, for example, or ingredient needed to transform towards making a certain product. Other types of costs is the fixed costs. The fixed costs are simply most of the other things. So think about salaries, think about rent, think about utilities. These are costs that you're going to pay anyway, regardless of how much are you selling. So if you stop selling for a certain month for any reason, you still have to pay salaries for your team. You still have to pay rent if you have an office, and so on and so forth. You could spend money on growing the business in terms of fixed assets. So you could spend money on new property. You could spend money on securing new machines that ramp up your operational capacity. And at this stage, we call them capital expenditure. So they're not income, they're not a loss. They're an investment that the business makes towards increasing their sales or their numbers, but they are a cash outflow. And of course, the final type of outflow is taxes, which is typically, of course, there are different kinds of taxes, but mostly they are variable with your income or how much money does the business make. So here I want to highlight the logical structure of a typical cash flow sheet. And also I want to highlight the difference between the sophistication of sheet of the cash flow depending on the stage of the business you're at. So for pre-revenue businesses, I don't recommend to have a full-fledged cash flow statement. I recommend to have a simple sheet of cash in versus cash out. And you start with an opening balance. You add whatever comes into the business, either a loan or maybe an investment or angel investment and so on. And then you record any cash outflow going out of the business. So maybe you're buying some equipments, or you're paying salaries to your team, you're paying rent and utilities and so on. For the post-revenue startups, this example is very handy. So you have three main elements. You have cash flow that is coming from operations, which means how much money have you earned, your income, which means how money have you spent in terms of inventory, or how much money you have still due towards suppliers. So all of that is cash flow coming from operational activities. and any cash outflow is recorded in negative, while any cash inflow you record it as a positive transaction. And then you have cash flow coming from any investment or investing activities, which means any investing activity that the business conducts. So remember, I talked a little bit earlier about the capital expenditure. If your business buys a new property or a new land or a new equipment, these are transacted or logged as capital expenditure. And if they're a cash flow, then you record them. If they're outflow, if you buy new machines, then you transact them as negative. And here in the example, you could see if you sell actually that property at a later stage in time, then it is transacted as a positive cash inflow. And finally, the third part of the cash flow statement, of a typical cash flow statement, is the cash flow from financing activities, which means any addition to cash that the business gets out of typical investment activities or financing activities, such as securing debt or a loan or equity investment. And as you can see here, it's recorded as a negative at one instance, which means that the loan is secured by the company. If the company at a later stage decides to issue some dividends or pay back some of its investors, then it's a cash outflow that is resulting from a financing activity, and then it's transacted as a negative transaction. And as I said, you have a net increase that is coming from these three items, and you have an opening balance. So if you add those together, you arrive at your cash at the end of the year. So it's very important to keep track of the cash and make sure you have a very simple and effective cash flow statement that you use weekly or monthly to review the cash position of your company in order to be able to be better equipped and prepared for your growth. At this point, I'll start moving to talking about the income statement for a little bit. However, I want to ask you guys if you have any questions, if you have something I could clarify, would be happy to do that. All right. So the income statement. The income statement primary objective is to measure profitability over a certain period of time. So it's one of the key elements that investors use in order to assess how profitable the business is and how profitable it might be in the future. And if you remember, when we were talking about the growth rate, we were talking that it's very favorable to try and keep a constant growth rate, which gives you something that we call the J curve or the hockey stick. And as you can see here, it measures the either income or loss of the business over a period of time. So we want to see a period of time through which the income of the business increases in a scalable manner or an increasing rate. So if it doubles a certain month or a certain time period, then investors want to see that rate increase. So if you're growing 20%, you want to see either that your growth rate is increasing or at least you're maintaining a stable growth rate. And as your numbers increase, your absolute numbers also are bigger. And the logical structure and breakdown of the income statement is very, very simple. First of all, you start by your revenue, or how much money is being collected by your business from conducting its main operations or main activity. So think about if you're selling a product, then the revenue you collect is the revenue coming from selling that product, or maybe you provide a service. So the revenue would be the total amount of subscriptions that user pay you in order to use your service. So simply, revenue is the number of people using your product or the number of people using your service multiplied by the unit price of that, maybe the subscription or the unit price of that product. And that's the first line in the income statement. And then to try and reach how much money you actually made as a profit, then the first thing that you do is you try to move away the cost of sales, or typically called the COGS, the cost of goods sold, which is usually the variable cost that is directly relevant and affected by how much money, how much products you're selling. So again, think about any raw materials that you're using, any ingredients, any raw components if you're selling an electronics product, for example. So that's the cost of the goods sold, which is also calculated by simply figuring out how much money does the unit price cost in terms of material or ingredients or components, and then multiplying them by the amount of products that you've actually sold. And after subtracting that number, you arrive at the gross profit. And the gross profit is simply your revenues minus the cost of goods sold. And then afterwards, you start to remove any fixed expenses. So think about operating expenses, think about any costs related to sales commissions, to administrative costs, and so on. The salaries of your team, all of that is fixed cost. And then you arrive at the EBIT, which is the earning before removing any interest or before removing any taxes. And then you arrive at the net income, which is the profit that you actually get out of conducting your business. And here I want to show you how simple it really is. This is a snapshot of Apple's income statement throughout 3 different years. So as you can see, it really follows the same logical breakdown. It starts with the sales, how much revenue the business is collecting, and then removing the cost of goods sold, arriving at the gross profit, and then removing any fixed costs, whether R&D or operating expenses, selling or administrative costs, arriving at the EBIT. And then after removing any interest expense or taxes, you arrive at the net income. Here I want to also talk a little bit about the balance sheet and the rationale of the balance sheet, that it shows you a snapshot of the end-to-end business position at a certain period of time. So it doesn't show you difference over a certain period, it just shows you the current position of the company at a fixed point in time. And the rationale is very simple, that the assets that the company own, whether current assets like inventory or non-current assets such as or fixed assets such as equipment or properties and so on, has to be equal to the liabilities or the amount of value that the company owes to other entities. So think about loans or debts, or maybe a prepaid expense that the company still has to pay. The assets has to be equal to the liabilities plus any value that the investors have put into the business, whether is it an initial investment or any income that the business retain to fund back into the business. And I'll not dive into more details about that. I just want you to understand the whole rationale of constructing a balance sheet. So always think that the assets that the company own has to be equal to whatever the company owes to other entities, plus any money or any value that the shareholders or investors have put into the company. And here what I want to highlight is the difference between the income statement and cash flow, because you might think, okay, if the cash flow is cash in and cash out, and the income statement simply measures profitability through having the revenue in and subtracting it with the costs. So what is the difference between those two statements? The main difference is that the cash flow statement does not or actually includes any cash transaction. So let's take an example. If you think about capital expenditure, if you think about paying money to buy a property, that is not a loss, because you've made an investment to increase the size of your operations, perhaps. So it's a cash outflow, so it's recorded in the cash flow statement, but it is not recorded in the income statement because it's not an income. Also, alternatively, think about selling an equipment, for example. If you have a couple of old laptops that you are renewing, and then you maybe sold the old ones, so you're getting cash inflow, so it has to be recorded in the cash flow statement, but it's not an income because it's not part of your core business activities. So it's not going to be recorded in the income statement. Also, as I talked a little bit, the difference between the balance sheet and the income statement is that the balance sheet, it only reports the company's assets, liabilities, and equity in a certain snapshot, versus that the income statement measures your company's performance in terms of income at a certain point in time, or measuring a period of time. Great. So here at this point, I would like to talk very briefly about how to go on and think about modeling, and how do I try to build a financial plan and the projections based on making sure I'm keeping track and keeping a good record of whatever aspects we talked about that I need to keep track of. And you need to think about it this way. Modeling is only the step of translating a real world problem or real world questions or environment into a modeling or into a conceptual model. So simply, any model has to answer some questions. So maybe that model is, how much can we spend on sales? Or how much money do we expect to gain in the future? Or how much money do I need to grow at the desired rate? So this is a question that you build the model in order to answer. So as you can see, we have a real world problem or a question. We try to build a model which is conceptual. I'm not talking about spreadsheets just yet. I'm talking about a conceptual model that you could write with your hand in a paper, using a paper and a pen, for example. And then you try to translate that into a spreadsheet model in order to answer your question. And then by answering your question, you have some form of insights that allows you to answer the original question. So the very first step with building projections is you need to start with a timeline. You need to start with the grand vision. Okay, what do I need to do? What are the major milestones that I need to achieve, or that I'm going towards in terms of growth and in terms of selling my product? And as you can see, this is a very simplified example. So we're not talking about any costs. We're not talking about numbers. We're just talking about the major milestones that my company is expected to do in the future. So as you can see, there is a milestone for prototype, or maybe releasing your final product, and by the time you expect to have a certain revenue in a certain period of time. And this sort of help you when you're thinking about how much money you should spend, or how much money you expect to bring into the business. All right. And I talked about this a little bit earlier, but remember, your objective is to build a model. Your objective is not to build an array of numbers that are hard-coded and manual. So you should, as much as you can, try to use formulas and parameters instead of manually inserting numbers into your model, because numbers can come later and can be changed very, very easily. So step 2, after building the conceptual model, you need to go back to the spreadsheet and try to start using formulas that translates your vision of the conceptual model. So start with very simple assumptions, and I'll tell you an example shortly. Make assumptions. You could also feel free to make assumptions about the numbers you expect, and then try to optimize them later. And make sure to differentiate between the input cells and the cells that you actually calculate within the model. Then step 3, as I told you, then you have to review and verify your numbers. And when you experiment, you realize some other things that needs to be done in terms of iterating and optimizing your number. And here's a very simple example of building a model, right? So those are my parameters. Imagine this is a company that sells a certain product over the web. So the model is simply based on two key assumptions. One is the conversion rate of sales from the website visits. So as you can see, you have projections of the website visits, and then you have a number of units that get sold out of a certain number of visits with certain employees that translates into costs. So you could actually use that as your building block for initiating your simple income statement and cash flow statement. So some tips when you're doing your plan is you have to always start with your worst case projection. Maybe you have other scenarios as well. So you have best case scenario and the scenario that most probably is going to happen, and then the worst case scenario, but you have to know what is the absolute worst that could happen, so you are prepared in the off chance that you see it. You have to assume zero investment, and that helps you really bootstrap and helps you build value in a proper manner without burning too much cash on trials and experiments. And also assume zero initial revenue, because by doing that, you really are prepared to keep on operating with minimal cash inflows. So you are really prepared and equipped to go through that, provided that this happens in terms of market, or if you see that your numbers are not really improving that much, then you have an elongated period of time to try and change that. And then try to create your budget in steps, in a modular steps, and try to make sure that each step generates, or each milestone tries or goes toward generating revenue for the next phase. I wanted to talk a little bit about bootstrapping, but since we don't have a little much time left, I'll go through this very quickly. So the idea is to try and build value and create your business with the absolute amount of little money that you have to. So think about what can you leverage at no cost, whom do you know can help you with no cost at the beginning, how can you target people that can actually help you and provide value for you without having to pay much cash at the beginning. The final part that I want to talk about is very, very important, and it's how do investors evaluate startups? And I'll get through that part very briefly, but it's also, I want to highlight its importance. So your startup idea is a hypothesis. It's a hypothesis of why you think this business will grow very, very quickly. And for me, these are the things I'm trying to figure out when I'm hearing a pitch for a startup. So every startup for me is about three things. It's about a problem, it's about the solution, and it's about insight. So I'm trying to figure out the problem. And I'm trying to figure out, the first thing, whether the problem is big enough or not. So you have to really reflect and think about yourself when you're talking about your problem. Is it big enough? Is many people affected by that problem? Is this problem actually growing? More number of people are getting affected by it as time goes by. Is it urgent? Do people suffering from that kind of problem have to solve it right away? Or you could wait for a month or two, or probably a year before trying and solving that problem? How expensive or how cheap is it to actually solve that problem? And investors like to see a very expensive problem. Is it mandatory? Do people suffering from this problem absolutely have to, in terms of legal aspects, for example, have to solve it? So think about changing regulations, for example. And final thing, is this problem frequent or not? How many times does your typical user have to solve that problem? Is it daily? Does he have to use it or has to use your solution 3 times a day, or maybe 3 times a month, or maybe 3 times a year, or maybe once? And in terms of solution, the simple thing really is, the only thing I want to say about the solution is you don't start with the solution, you start with the problem. Because typically we find entrepreneurs who are maybe very tech driven and they understand the technology, and they say, it would be really, really good if I could use this technology to create a solution that would facilitate a certain transaction. And usually we call that a solution in search of a problem. So you don't need to start with the solution. You need to be very passionate about the problem. And then after realizing what this problem means, and if it's big enough or not, then you go towards building your product and building your technology. And then the final thing, the final important component of the startup is insight. And the insight is your explanation, is your vision on why your solution is the one that would actually succeed, and why your company is going to grow based on that problem and that solution. And what I want to go through here is that any insight has to have certain unfair advantage. For any startup to grow, you have to have a certain unique advantage that no one else has, that allows you to grow and allows you to attract customers very quickly. And you need one, you need at least one. So what are the types of unfair advantages, and how do investors think about them? There are mostly 5 types of advantages. One is the founders. So maybe you have a very strong team that is really sophisticated in terms of the product. You have a super expert in certain domain, and my advice here is to try to navigate and try to translate the sophistication of the founders in terms of numbers. So think about it. Do I have the right team? So, and part of how we went about it to understand the founder unfair advantage is to try and figure out how many other people can do the same product. So is it 1 out of 10 people in the country that could do the same product? Or is it 1 out of 100? Or is it 1 out of 100,000? And so on. And usually 80% of the startups don't have a founder's advantage. They have other types of advantage. All right, I'm getting comments that the picture is not clear. I hope it is clear now. All right. Okay. The other type of unfair advantage is the market. So are you simply working in a space that is that is growing very fast and very big, that to the extent that if you simply drop any product to the market, you're going to gain traction and you're going to gain popularity because you're dealing with a very huge problem? Investors typically like to see a market that is growing around 20% annually. The third item, or the third unfair advantage, is the product. So you could think and ask yourself, how much better is my product? In comparison to other products? Is it 1 time better? Is it 2 times? Is it 10 times? The final thing is, how are you able to attract your customers? So are you in a kind of business that needs to spend a huge amount of money to attract and convert customers, or you're able to simply attract them in an organic manner without paying too much money into customer acquisition? The final thing is monopoly. And monopoly here, we don't mean it in the typical term, but it's simply a measure of how do you get stronger? Does your business get stronger as it grows? So think about any business that operates in network effect mechanism. So as you grow in users and in revenue, do you grow? Is it harder to compete with you? And this is also a type of an unfair advantage. The final thing I want to talk about is, how can I develop a sense of developing a startup, of valuing a startup? And very simply, I'm not going to go into the details. I'm just going to try and give you the very basic rationale about it. Your startup is like a box. You have certain inputs to the box, and the box outputs certain value in terms of money. So maybe you have a very good technology, or you have a very good team, and the box computes all of that and then outputs certain income and profit. And the more profit that the box generates, the more valuable it is. And you could think, okay, or a very nice way of valuing a business is to try and make an analogy about property. So ask yourself, what are the ways that I could value a property that I own, or my house, for example? One way of valuing your house would be to simply figure out how much money it did cost to build it. So you could say, okay, the land has a certain cost, and then the building process itself had another item of cost in addition to the materials that we used, and the sum of all of that would be the total value of the property, or the total value of startup. And using the analogy, using that manner, would be that the startup value would be the total value of its assets. So it's a cost-based mechanism of valuing a startup. The other quick way to value a startup would be comparing it with similar startups. So you could say, if I want to value my property, I'm going to look at similar properties in similar locations and similar features, and that would be close to the value of my startup or my property. And the final and third way, which is mostly used by later stage investors, would be measuring how much money or how much income can the startup bring into the future, which we call the discounted cash flow method. All right. And here I just wanted to give you some of the names that most of investors use towards valuing a company. And I'd really like you to explore and learn more about them. And please feel free to reach me out and ask me about them. I would be happy to do that. And I think because we're running out of time, I would be very happy to take some of your questions right now. Please feel free to drop any questions or comments, and I'll be happy to answer them. So while you guys are doing that, maybe I'll talk a little bit about some of these methods, and actually recommend some of them to you to read more about. One of the methods I really find very relevant towards valuing a startup that is still operating, or a seed stage startup, is the Dave Berkus method. It's the fifth one into the table. And this method is developed by one of the Silicon Valley based key investors. He's called Dave Berkus. And simply, he assesses or value a startup based on the value of, or the sophistication of 5 key success factors. So he goes on about the team, for example. He goes on and says, okay, the team is very sophisticated. Clearly, that startup has a founder's advantage. So I'm going to assign a certain value towards, just because I think they are going to succeed because of the team. And the risk of having a bad team is really, really low. So I'm going to assign a certain value. And typically, that value could go, of course, it differs from a place to a place, from a place to another. For example, in Silicon Valley, any instance could be value from 100 to 200 or maybe $300,000. Maybe it differs in other regions in the world, but the idea is clear that we have 5 main factors, which is the product, which is the team. So every investor picks his own important factor to assess, and then gives a rough value based on the sophistication or the level of risk that he is expecting to see during the operations of the startup. And the rationale of why most investors are doing that for seed stage startups is because plans change very fast. And it's very rare to find a startup that actually goes on and achieves the pre-instated plan before going into operations. So usually startups operate a bit, they find certain opportunity in the market, they shift, they pivot, they change their plans. So it's almost impossible to value a seed stage startup within or using the traditional methods of valuing a company. All right, so I'm still waiting for your question, guys. Would be happy to answer them. And while waiting for your questions, I'd like to thank you so much for your time. I hope that session gave you a clear idea on the basic fundamentals of managing the finances of your startup, and also how do I go on and start thinking about projecting and expecting or estimating future trajectory in terms of revenue and in terms of my financial plan, in addition to giving you the other perspective of the investors and how do they go on about evaluating your idea and your startup, and what do they think about and how does the ecosystem actually goes and assigns value to companies. So again, I'm really happy to conduct this session today. I want to one more time thank the TRA team for their continuous effort and for the chance and availing this opportunity to give that session as part of the hackathon's activities. And I'd like to thank you guys so much. But before we wrap up, I want to take a question. So we have here Mr. El-Kabi asking, if the cost is 500 in the first month, how much should I save in case of the worst case situation? So it really depends on other factors. It depends mostly not only about your burn, but it also depends on how much money you have left, and it most importantly depends on what kind of costs are you having and how you could cut down some of them. So if you think your cost is 500 in the first month, so think about, okay, is there a way that I could actually decrease that kind of cost? Is there a way I could leverage the help of any shared resources to try and alleviate some of that cost and save more to increase my runway? And also, a very important part of that question would be trying to figure out, okay, if I'm spending 500 per month, what kind of growth am I expecting to see in the coming months? And when would be the appropriate or the logical point at which I'll start to generate revenue out of the business? So that helps you compute and give you a very clear picture of how much can you survive while spending the same amount. So if you expect to have an influx of revenue by month 10, for example, and you only have the ability to spend with that rate for only 5 months, then you need to do something about that. You need to cut your costs. You need to ask for help in terms of access to finance. You need to talk with investors to elongate or extend your runway so you survive. Okay, and on that note, once again, thank you so much. Really happy to have conducted this session. And again, thanks for the TRA for making this chance possible. Have a pleasant day. Thank you.